Welcome to the Nicolera Show. This is the place where we explore big ideas with people having a big impact on our world. I'm your host, Nick Hilera, serial entrepreneur, author, early morning riser, and seeker of truth and wisdom. Join me as we explore the journeys and discoveries of fascinating people who are literally unlocking the secrets to creating a life of both success and fulfillment. Each episode will arm you with insights, ideas, and practical perspectives on what it takes not only to be financially and personally successful, but also how to start having authentic impact on the world around you. Hi, everyone, and welcome back to the Nicolera Show. Our summer finance series continues. Up next is Darius Dale, the founder and CEO of 42 Macro, an investment research firm focused on democratizing institutional-grade macro risk management processes. Armed with his passion for economics and markets, his incredible financial mind, and the noble mission behind 42 Macro, Darius is a rising star in global finance. He's amassed a huge following and has become a sought-after voice for his clients and followers around the world who are trying to understand the fast-moving, ever-evolving macro landscape. There are a bunch of reasons I wanted to have Darius on the show. First of all, I think what he's doing with 42 Macro is incredibly valuable. Whether you're an investor or not, understanding what's really happening in the global economy at this level of sophistication and detail is critical to the mission of citizenship, especially for those who wish to lead. I think his macro frameworks are elegant and spot on, and his commitment to Bayesian probabilistic thinking really helpful when dealing with something as complex as the global economy and investing in financial markets. For investors, understanding the kind of work that Darius and his team do every day is a good reminder for just how serious of an endeavor this can be. Investing is a way of life, not just something you do occasionally, and that message shines through in this conversation. Finally, Darius is someone who's very much aligned with our mission of service here. Not only is 42 Macro inspired by a noble intent, but Darius is someone who is constantly looking to give back by supporting financial literacy programs and mentoring young people who are trying to improve their lives. I know you are going to walk away inspired when you hear how Darius transformed the trauma of some tough childhood experiences into a passion for being both successful and doing some good in the world. Thanks for tuning in and hope you enjoy. Hey, everybody, and welcome back to the Nicolera Show. Our guest today is Darius Dale, the founder and CEO of 42 Macro, an investment research firm providing sort of institutional level research, but with the intent to sort of democratize it and make it available to as many people as possible. Darius, welcome to the show.
Nick, thanks for having me, man. I want to say you're a good dude and really, really smart dude. I've been following you to keep up on the commercial real estate saga, so I just want to say thanks for all your work as well.
Yeah, I appreciate that, man. And thanks for taking the time. Something fun to begin with. I realized this morning as I was preparing for the talk is that you're the second ex-Ivy League football player that we've had on the show. So.
Oh, nice. Who's the first?
We had a rival, a friend of mine from law school named Afam Onyema who played at Harvard.
Gotcha.
So I don't know
what position.
He was. He said he was a defensive end.
Oh, was he number 50? Long arms.
Yeah.
Yeah, it must have been him. Yeah. No offense to my friend, but I got the better of him every time. But he's a good player. I'm not even talking trash. He will agree with that.
Yeah. So his story was, his dream was, to play football. He was obviously very smart because he was at Harvard. And then he got hurt. And I don't know, did you have the same kind of thing where did an injury pull you out or did you just give up on it? What was your...
No, in a weird way, man. An injury kind of like really changed my life in the better. In high school, I was sort of a late bloomer in high school. I had a really catastrophic knee injury and my sophomore year heading into my junior year when I was slated to begin starting. We had a pretty decent program, so it's not like I could have started as a freshman. But this knee injury, like basically I was out for like 18 months. So I didn't I started playing football as a sophomore. I didn't start starting games until my senior year. I was first team All-State, getting recruited by all the big, Pac-10 back then, conference schools. But the reality is most of those schools had run out of scholarships by then because the recruiting cycle, you typically are signing heading into your senior year. So a lot of those schools are like, yeah, man, we really want you. We're going to give you a scholarship, but like, it's got to come in the spring or something like that, right? We literally don't have any more scholarships for this position group. And so that's kind of what I heard from most of the Pac-10 schools. But then my high school coach, during the season was sending my tape to the Ivy League schools. I had never heard of most of these schools, right? Like, I'm like, who the hell is Yale? Who's Dartmouth? I've heard of Harvard and Princeton. That was it. Like, you see Harvard and Princeton on TV. And so, like, the Fresh Prince of Bel-Air is how I knew of Princeton, actually. And then obviously Harvard's this big global brand. But like, I never heard of Yale. I never heard of Columbia. Never heard of all these other schools. And so when they started calling me and recruiting me, I was like, oh, this is nice. These smaller schools from the East Coast are like coming all the way out to Seattle to see me. But like, guys, I'm getting recruited by UW and USC, like, guys, don't waste your time, basically, like, you guys are, you're totally wasting your time. And so I didn't have the sort of, I didn't really understand the potentiality for that opportunity until my AP marine biology professor, Craig McGowan, who happened to be the marine biology professor at University of Washington. We had this like program where college professors would teach AP at our school. And he pulls me aside one day because he sees all these coaches pulling me out of class and whatnot. And he's like, dude, you get put out of class every day. What's going on? Like, are you going to make a decision? I want you in class. And so I was like, yeah, I've been like getting recruited by all these small schools out east and whatnot. I like the guys, great coaches, but like, I'm still waiting on UW. They're trying to move some things around so they can offer me and all this stuff. And he goes, I'm going to do you a favor. I'm going to call up Coach Gilby and make sure that he does not offer you a scholarship. Go to Yale, is what he told me. And like right in that moment, like the light bulb clicked. Like, oh, they're not just blowing smoke up my ass. This is like a really good opportunity for me and my family. And so that's kind of how my life changed, man.
So
shout out to that knee injury.
Yeah, it's so funny how life works like that. And like that advice is so right. Like Yale's like one of the top 1 or 2 possible educational experiences that you could have as an undergraduate. Like it's incredibly difficult to get into. And it does change your life. Like for all the people that I know that have gone there, like it's like one of the remaining ways left in the American democracy where you can like absolutely change your trajectory and make it to the other side, where life is, a different animal.
100%, man. And I definitely feel that, we grew up very poor, like we were always in and out of homeless shelters. My parents struggled with drug and alcohol abuse growing up. And, we were in and out of homeless shelters, living in motels, kind of living in, just our living situation was really tough. Growing up, there's a couple times where we were, homeless, actually just homeless. And just being able to like get to a place like Yale, realizing that, hey, I'm a fish out of water. Like, I don't know. Again, I don't really have much in common with most of these kids outside of the guys who may play football or basketball or something like that. It was a really, really tough experience for a variety of reasons. One, I'd never been in an environment like that where most people, have resources and, had the resources to really prepare themselves academically and otherwise to be at an institution like that. And so my first, kind of year was like really tough. That was a real hard transition, coming from that environment and being in this newfound environment. And I actually was on academic probation second semester freshman year because I didn't have the preparatory habits to be a good student. Right. Like I thank God and all these things that happen and they're to be blessings and blessings in disguise, because if I hadn't gone through that experience, I don't know what would have come of my Yale scholastic experience. I mean, people do fail out of that school. It's Yale. You know what I mean? And so like, I'm very grateful for that because it really gave me the foundation that I needed as a student, to really be successful in that. And it really helped me. I'm going to say my last 3 semesters or last 3 or 4 semesters, I had a 4.0. But this is coming from like having like a 2.0 when I walked in there, right? And so, it really does help to have that academic backing. But to find one thing I'll finally say is you're spot on, man. If you take away one thing from this podcast interview, is make sure you're doing whatever you can to support education programs in your community. Mentorship is obviously very helpful too, but if something has anything to do with education, definitely make sure, because that to me, it really did help change my life.
Yeah.
And my family's life, right?
Yeah. This is great advice. Hey guys, this is Nick. I wanted to take a quick break from the episode to share some exciting news. In addition to the podcast, I want to make you aware of some additional content we're putting out. And best of all, it's 100% free. Our Profit Plus newsletter consists of weekly insights about what it takes to find meaning in the pursuit of modern success. This is the place where we explore big ideas at the intersection of markets, business, politics, and life, as we seek to empower our readers to have an authentic impact on the world. If you're serious about finding fulfillment amid success, then definitely check out these additional insights. Just go to subscribe.nickhilaris.com. Again, that's subscribe.nickhilaris.com. Now let's get back to the episode. When you were younger, like you mentioned, you spent time homeless. How old were you when that happened?
So a couple times, man. So fifth grade, definitely. I remember sleeping we slept in a van. Summer fifth grade. When we moved to Seattle, we were homeless. We didn't have anywhere to sleep. We actually moved to Seattle on a Greyhound. So this is how silly when you're a kid, you're like, oh, we're moving to a different state. So I'm thinking my parents have like this, job lined up. Things are going to be better. We're moving from this, horrible neighborhood with two horrible neighborhoods, one in East St. Louis, one in U City, in St. Louis. So we're like, all right, things are going to be better for us. And so we moved there on a Greyhound. Or this is what I'm thinking in my head as a, I was thinking I was heading into sixth grade. It's like fifth grade. It's fifth grade summer, or summer after fifth grade, rather. We get there from moving to St. Louis, to Seattle from St. Louis on a Greyhound. We sleep in the Greyhound bus station for a couple days because we didn't have anywhere to go. We had this sort of halfway house type setup, arranged eventually, but like it took like a day or two for us to get into it. So we didn't have anywhere to go. So we were sleeping in the Greyhound bus station when we got there.
Wow. And do you remember, I mean, it's a long time ago, but do you remember like what you were thinking in those couple days? Like, was it just you're going through it, or were you like, what the hell's happening?
So this is pre-internet, right? Like this is pre-social media and all this stuff. So like all you really knew in life was what was happening to you. You know what I mean? And what you saw on TV. And obviously I knew what I saw on TV was not indicative of my reality. So like all I ever known was being very poor. We were always struggling, to put food on the table or keep a roof over our head, literally. So like it didn't really, I guess it didn't impact me the way it would now. Like if I was suddenly living in a Greyhound bus station now, my world would end. But as a 12-year-old or whatever, you don't realize it. And so that's the beauty of kids, right? They're so resilient and they're so they have the ability to grow and overcome a lot, but they also need a lot of help. And I got a lot of help, right? Like I'd say two of the biggest things that ever happened in my life. Obviously, one of them being Coach Burgraff for sending my tape to the Ivy League schools because I would have never thought to do that myself. Right. That's really what opened that avenue for me in terms of getting recruited by those schools. But then also when I was when we were in third grade, we got evicted and we were in a homeless shelter next to the school called Del Mar Harvard, ironically. And it was like a K through 12 type college preparatory, like one of these academy type schools. You get really good college preparation there. And because of the way they zone in St. Louis, we were able to go to Del Mar Harvard because the shelter was near there. Right. This is a school that I would have never been able to go to otherwise because it's in this like ritzy neighborhood, but there's like a shelter near there that allowed us to go there. And honestly, man, that year of schooling changed my life. Like I went from being like a smart kid in my, kindergarten or first grade class or second grade class to being like, when I went back to my original school district or original school after that third grade year, like in fourth grade and fifth grade, I was like multiple grades ahead of everyone. And so that just kind of gives you a sense of like, the education gap and how early it starts in this country for so many kids, so many kids who are struggling with those resources. So again, if I can make another push, definitely get out there and try to contribute because it really does matter.
Yeah, I completely agree. I feel like it's the one intervention that we know for sure can work in either direction. Like if you have if you get access to one of these programs, it absolutely statistically will like improve the outcome for sure. And vice versa, 100%. If you don't, if you go to some garbage school, which unfortunately a lot of kids in this country go to, it's like, it's not a life sentence. Like people do make it out of that, but the odds go down by a lot. It's really incredible. The statistics.
It is incredible.
It. Yeah.
No, totally. So I've seen a lot in my, 36 years on earth, and I can definitely tell you what works and what doesn't work in that regard. And you're absolutely right, Nick.
And this experience, I wanted to talk to you about this at the end of the conversation, but that's okay. We're going to flip it because we're here. One of the questions I had for you is like, on Wall Street, there's not a lot of people who have that sort of experience in any career, not just Wall Street, but just in general.
No, that's pretty much any white-collar career.
People, the number of people who grow up like that and then go to Yale and then end up, being an entrepreneur like you and, popular financial contributor to the world it's a unique arc. And I'm curious, like what do you think about success? How does that experience inform your definition of success? And what are you taking away from it?
So, I mean, selfishly, success for me is being able to support my family, right? That's like, especially, my mom and, my father, my stepdad passed, but just being able to take care of my mom and my family back home, that's something that's really important for me. But number two, being able to give back and be a leader and a mentor and a philanthropist for, a lot of organizations and folks who are in similar struggles. I mean, that's, to me, it's like nothing gives me more passion outside of like what I do day to day work wise than being able to support, organizations and children in these types of environments. Because, again, you don't realize it when you're growing up. Maybe the kids today now, because they all have Instagram and Facebook and stuff, but you don't realize there's this big, better world out there. And unless you're exposed to it, you're probably not going to do the things that you need to do on a day-to-day basis to achieve it. Right. Like, it's not that you have the inability to achieve it. You probably have plenty of ability to achieve it, but you just don't have the opportunity because you don't know what the practice habits are. When I got to, I didn't know what the proper study habits were. I was always just 2 grades ahead of everybody, but that doesn't work at Yale because you're not going to be 2 grades ahead of everybody. You're going to be 2 grades behind most people, actually, because these kids all went to Exeter and, whatever, Choate and all this other stuff. Right.
Yep.
And so that to me is, that's what success looks like for me. But I mean, even in the context of like, I had a pretty, quick rise up, my career in terms of Wall Street. I was like meeting with, global CIOs and for all these big asset managers and stuff at a pretty early age, so like, it was always tough for me, like, not being a young Black guy in a room, like just like having different life experiences. But it did matter because like, I get in the room and like my boss would be chit chatting about this and that. And I'm just like, I have no idea what the small talk with these people about. I have no experiences that connect life experiences.
Yep.
As soon as we start talking about finance and economics, then the bright lights come on, and I'm the star of the show. But when it's all this other, all the downtime and all this other stuff, it was just tough. Even at like client dinners, I'm like, I don't really know what to talk about, because I have very few life experiences that overlap with these people. So that stuff does matter. But it definitely matters. But it's not the end of the world, right? And I'd rather be a pioneer in that regard than someone who's kind of shying away from it.
Yeah. So where they talk about like summer camps and country clubs and
exactly, you know exactly what I'm talking about. Youth hockey. We can't afford youth hockey in the hood.
Yeah, totally. It's a different set of life experiences as you described it. That's interesting.
Yeah, it's all good though. We're all here together, man.
Let's take a quick break to hear from our sponsor. This episode of the Nick Halera Show is brought to you by Metros Capital. If you're an investor looking for direct access to real estate investments, then we'd love to talk with you. Investment opportunities at Metros Capital balance financial returns and community impact. To learn more, contact us at metros.nickhaleris.com. Again, that's metros.nickhaleris.com. Now let's get back to the episode. Well, are there any of the organizations that you work with that you want to like make a plug for? Because we're always trying to give our listeners and the readers of the newsletter like ideas. So anything. I can also include it in the show notes.
Yeah, I would say Project Come Up is probably my number one, like that organization I spend the most time and resources on. Vox Academy out in LA as well. But Project Come Up, what I think, if they're successful in their mission, they could be revolutionary, because what they're trying to do is create curriculum that could be portable to different schools. Obviously, like, the schools at the states and everything going to get in the way in what they teach kids, but like they're trying to create like financial literacy curriculum and just some general kind of economic curriculum that can be portable to schools and allow kind of school kids to get their hands on some of this best in class like education. It's obviously not going to be administered by best in class instructors in every setting, but to me, it's something that I see that it's like, this is actually scalable and can really actually have a big impact. So shout out to Project Come Up.
Project Come Up. Okay, great. And I'll research and figure out the proper links. But that sounds super interesting to me as well. There was a moment in time where this was probably about 15 years ago, but I was teaching a rudimentary financial literacy course in a charter school in LA to middle schoolers. Mm-hmm. And I realized that like I had a hypothesis that like financial education was an issue, but it's a serious issue. I mean, now that I've kind of grown up and I see adults that I engage with, most of my friends are kind of in their 40s. And there's a huge percentage that are, lacking the basic understanding of how finance works, but also like how this whole system works. And even some of these people are leaders, like political leaders, for example, don't understand anything about what we're going to talk about in the second half of this interview, which is kind of scary.
Well, think about this. Like nobody in my family tree has ever like owned a home. So when I go to buy a home, I'm going to have to do a bunch of research online. I don't have anybody to tell me like, oh, this is what you do. That's how to do this. Stuff like that, like saving for college and when my kids are born, like 529 plans. I don't know. I've never done that before. I'm gonna have to Google it.
Yep.
Nobody in my family has a 529 plan. So it's little stuff like that. You don't know what you don't know. Right. And like, thank God we live in an era where there's ample resources and all this other stuff. So I'm grateful for that. But like, the reality is like, it's not just poor people of color. I mean, there's plenty of white people who have no idea what this stuff is too. It's like,
Yep.
so it's financial literacy, in my opinion. And now we're getting tinfoil hat here. I think they don't teach it to us on purpose so that we stay enslaved to this, Wall Street system that everyone is kind of, forced to kind of interact with. Right. Like, I think it's a moat around their business models.
Yeah. That's an interesting point, and something that I've thought about over the years. I mean, if you think about like one of the things that's always bothered me about sort of the way this stuff is taught is we celebrate these things. Like even if you take like the Yale experience, right? Even at the highest level, they're teaching like modern portfolio theory and efficient markets hypothesis. And then like you start to do your own research and you look at people who've actually made money on this stuff, and they don't subscribe to that stuff at all. They take concentrated positions. They use leverage. Like they're not paying attention to any of that mumbo jumbo. And I always found that to be interesting.
Completely agree with you, Nick. I mean, this is maybe I'm gonna get disinvited from every like business school speaking engagement that I will have, but like I think by the time it winds up in a textbook, it's probably not very relevant for managing risk in financial markets, right? Like the market is very smart. There's a lot of really smart, hardworking, talented people trying to scout basis points out of the market every day, right? You know what I mean? Like if it's in a textbook, it's probably like known, right? Like there's some basic fundamentals like the Dodd and Graham and all that stuff, like CFA type stuff that is just like, this is what you need to know to even compete in the game. But I don't know if it's going to help you deliver alpha consistently, which is why, at 42 Macro, I try to teach this to all of our retail clients. We have clients that span the entire gamut. We have the world's largest asset managers, all the people and we also have, retail all the way down to retail investors. And so when I talk to retail investors about managing risk in financial markets, to me, it's like, you're not smart enough to do this on your own. I'm not even smart enough to do this on my own. And I have, almost 15 years of experience. Like it's your job to take the beta that the market is giving you in the various asset classes that you want to be invested in and chop off the left tail using systems. If you're trying to go, well, I want to be long this and short that, and I think this, therefore, you don't have enough time if you have a full-time job to do that well. There are people who get paid hundreds of thousands of dollars, if not millions of dollars, to do that poorly. Right. You know what I mean? So for you to think you're going to do that well with like 30, 45 minutes a day of listening to me or somebody else, some other talking head, I got news for you. You're not, and so the sooner you learn that, the better your return profile will be.
Yep. Yeah. It's so competitive out there. And even among the sort of giants, like if you read like Market Wizards, right? Yeah. Like a series like that, there's like 30 or 40 individuals in the world, and even they're getting it wrong, like on a very regular basis.
Yeah. Oh, totally. Totally. Oh, yeah. Stan Druckenmiller, who I think is arguably certainly one of the best traders of all time. You can put him up there, PTJ or Stevie Cohen, some version of those three, in my opinion. He routinely says, I'm wrong half the time.
Yeah.
It's about making money when you're right and risk managing when you're wrong. Yeah. Right. And like what we try to do at 42 Macro for retail investors specifically, because obviously we have different messages for our different audiences, but for retail investors specifically, it's about just do that. Make money when you're supposed to be right, i.e. when beta is giving you the return profile that you're looking to seek from financial markets, and chop off the left tail. If you can focus your efforts on one particular aspect of tail risk, right tail or left tail, you're going to do a lot better than someone who's constantly trying to, to monitor the entire distribution of outcomes. Because again, if you're not doing this full time and don't have a lot of experience or expertise at doing this full time, at a high level, you're probably going to do it poorly. Right? Like it's like trying to play an NFL game with no training, no practice, no coaching, no play calling. You're just going to run out there and play quarterback. Well, guess what's going to happen when you run out there and play quarterback? You're going to look like, some of these, D-list quarterbacks.
Yeah. Or worse. Yeah.
Or worse. Well, I'm being kind, but yeah, most likely worse. Anyway.
So yeah, this is a good time. Tell me more about 42. Like, where did it come from? And give me a brief like description of the business.
Yeah, absolutely. So 42 Macro, we're about 2.5 years old now. We're an institutional investment research firm, but as you said, it's important for me to democratize our research for everyone, right? I don't particularly care who reviews our research, because at the end of the day, I think every investor who's operating in liquid financial markets needs a macro risk management process. That's what we sell. We sell an institutional macro risk management process. This is not some shop where a guy comes up with macro ideas and narratives and theses and tells you put on this trade or put on that trade. It's an institutional macro risk management process that is, takes all the different, core tenets of institutional finance that I think are very relevant for managing risk. And we try to apply, kind of my institutional knowledge base of how the actual business cycle works and how markets have interplayed with that historically to helping investors kind of, to help investors get a real full understanding of that full distribution of outcomes, right? Like that's what we're always trying to help investors do. Sometimes there's more tail risk in the market. When we identified back in December of 2021, sometimes there's more right tail risk in the market when we identified back in January of 2023. Right? It's not about, hey, I think the market's going to go up a lot or I think the market's going to go down a lot. It's these same processes that we're constantly doing and refreshing every single day are saying this, and then 6-7 quarters later they're saying that. It's the same exact stuff though, and I think that's what's missing out there in terms of a lot of investors who interact with retail investors specifically. It's all about stock picks and ideas and themes and narratives and stuff that gets you to, it's stuff that grows your subscriber base. Let's be totally honest, right?
Right.
But at the end of the day, the stuff that grows your subscriber base tends to be stuff that teaches people bad habits with respect to investing. And so we just like to build our business the old-fashioned way.
Yeah, and taking a step back, like if you were to describe the risk management stuff to someone who's not sort of in this world day in, day out, how would you describe it?
Yeah, so in terms of how we think about risk management, in fact, I'm going to share my screen here because I think it's important to kind of put pictures to some of this stuff. So in terms of how we think about risk management, it's about being thoughtful about what it is that you're looking at. And so there's three core sort of tenets of what we do from a systematic macro risk management perspective that I think are based on my, near 15 years of experience in Wall Street. I've had well over 4,000 meetings with all the top asset managers in the world, across the world, Singapore, London, Japan, everywhere in the world. There's sort of three things that I think that these firms do well. The firms that I have the most admiration for and that have historically generated the best returns for their clients, I have the most admiration for is, there's three things. There's regime segmentation, is identifying with some high degree of confidence what regime you're in and what the probability of that regime persisting is in. That to me is like a big step of macro risk management. A lot of folks think about investing as themes or ideas. We think about investing from the context of regimes. Like, is this regime going to be persistent? How is this regime different from the last regime? And how is it going to be different from, previous regimes that have historically had similar characteristics? And more importantly, I think the biggest answer is, okay, how long is this regime likely to persist? And so answering those questions is all a big question of itself, but we have different tools and models that help investors figure that out. Bayesian inference, which is the number one thing I think we do better than most people who do what we do, including a lot of the big shops on Wall Street, the big bulge bracket firms, which is we are constantly looking at the same data sets. We're analyzing the same data sets day after day, week after week, month after month, with the same proven quantitative techniques to give us a sense of, okay, when is something changing? Is this changing? Is this really changing, or is it just a head fake? Is this okay? If it's changing, how is this going to impact the regime, the persistency of the regime, the likelihood that we might be in this regime a month from now, 3 months from now, et cetera, et cetera. And these regimes not only correspond to what's happening in the economics, but also correspond to what's happening in the markets, because that to me is the most important thing of what we do. And then lastly, having just general risk management tools. We have this thing we call our volatility adjusted momentum signal that allows investors to sort of get an idea, like a early warning sign of when the price momentum of a particular security or instrument is likely to change. And we use those volatility adjusted momentum signals and we feed them through this sort of master model that gives us a sense of, okay, is the regime likely to change based on some of the inflections that we're seeing in these volatility adjusted momentum signals for particular markets. And so, if, in terms of to answer your question, it's these three core tenets of our product that you'll see littered throughout our entire process that are constantly, in my opinion, helping our clients kind of stay one step ahead of the curve.
Yeah. And on the regime, what are some examples of types of regimes that you could find in this world?
Yeah, absolutely. So from an economic standpoint, the economic regime the market regime tends to correspond to the economic regime. Not always, but generally speaking, it does. And there's been at least for the first part of 2023, there was a little bit of divergence, but in recent months they've kind of reconverged. And so in terms of how we think about regimes from a bottom-up standpoint, from economic standpoint, is looking at through the lens of growth and inflation and the interplay between those two, and specifically the delta in growth and the delta in inflation, because what we found is through very careful back testing is that the market doesn't really care about the level of anything. The market is very good at understanding the rates of change, and particularly the rate of change relative to consensus expectations. And so let me go explain those regimes and then explain kind of what I just said. So Goldilocks, we call, we just use, standard economic nomenclature, but, for us, they mean something specific. Goldilocks means growth is trending higher and inflation is trending lower. How we measure growth is on using the OECD composite leading indicator. For growth, you can use whatever, metric you find if it backtests well. We use headline CPI for inflation because that backtests the best in terms of, anticipating dispersion within and across markets. So that's Goldilocks is growth up, inflation down. And reflation is growth accelerating and inflation accelerating on a trending basis. Inflation is when inflation is accelerating still, but growth is decelerating. And then deflation is when growth and inflation are decelerating. And so it's our job, we use some pretty sophisticated forecasting tools to project those economic regimes, but we also use some pretty sophisticated nowcasting tools to kind of nowcast whether or not we're actually pricing that in from a market standpoint. And so, as I mentioned, this is what we call our global macro risk matrix. This is the system that we use, that big system that we use with our volatility adjustable minimum signal that helps investors determine whether we're in a regime and what the probability of remaining in that regime is over some, relevant, financial market threshold, like 1 month, 2 months, 3 months, et cetera. And so that's kind of how we think about regimes, and how we built that system is based on the backtest, what we call our grid asset market backtest, where we backtest that fundamental model vis-a-vis different factor exposures in the asset classes. So we have Goldilocks being the typically the best performing regime for risk asset type exposures. Reflation is a good regime for risk assets, tends to be the worst regime for fixed income securities. Inflation tends to be one of the worst regimes for risk asset type exposures, and then deflation tends to be a little bit more mixed. So you have some sort of like growthy type exposures. Treasuries tend to do really well. Dollar tends to be doing really well in there as well. So we use those back tests to inform the system here that allows us to determine what the market is pricing in and what the probability of that pricing in is like, or what the persistency of that is over kind of a short to intermediate term time frame.
Yep. Fascinating. And I've been following your work for quite some time. First came across you on Real Vision, which is a platform where we both kind of had an opportunity to share our thoughts.
Great platform.
What's
Great
been
platform.
cool?
Shout out to Rob.
Yeah, it's they've been doing good work for democratizing finance, which I think is a mission that you guys share for sure, which I believe in.
100%.
Yeah,
100%. I mean, shout out to Rob. I mean, he's so me and my former seated hedge eye, and I would say Real Vision are arguably the two firms that have really did that for took institutional finance and brought it to mainstream America. There were other firms that obviously had come buy a newsletter business, but it wasn't hallowed halls of institutional finance. This was in kind of in this post-crisis era. Kind of starting with hedge eye and Real Vision. Those were like in my opinion, two of the biggest contributors to a lot of what we see now on finance Twitter, which is the discussion that retail investors are having and that institutional investors are having has never been narrower. Yeah. And it's because of firms like ours and Real Vision, et cetera.
Yeah. And I think people don't understand how big of a deal this last decade has been, because if you rewind the clock before these technologies or these media companies, whatever you want to call them, before they existed, like it was very difficult for an average American, even like a super successful business person, to get a window into the thinking. And now you go on Twitter and you basically could understand the macro views and even the positioning of like the best investors on the planet. It's really amazing what's happened in that short time period.
I think it's made the game way harder. I think a lot of investors, if they're being honest with themselves, have probably had worse results in the last 3 years than they've ever had, because I think there's so much information out there. Like the democratization of institutional processes, institutional insights has made the market smarter and has made the market's ability to price in things way faster. I think, every time I have a conversation with an institutional investor, we're having the same similar type conversation. Like, man, it just is harder. And so if something is getting harder, you have to be constantly iterating and evolving your process to take advantage of the new risks and the new opportunities, as opposed to, constantly just banging your head against the wall on something that may or may not be working.
Yeah.
We've that's something I really do pride myself in is, when, I tend not to have long periods of bad stretches, but, one of the worst, arguably the worst stretch I've ever had in my career was Q4 of last year. So market bottomed obviously in early October. We actually got the bottom call right. We said buy stocks then, but what we got wrong was we started shorting them again back in late October, early November. And you just squeezed, obviously throughout, especially I remember that October CPI print, it's the back of my hand. That's one of the worst P&L days I've had in my career. But, just, what I've learned from that, what I learned from that experience was a few things. One, we need to do a better job of being present on all the different factors that drive asset markets. And one of the systems that we built to account for that, to make us better at that particular feature, is what we call our macro weather model. And so this is sort of like the hallmark process we use to sort of manage financial market risk. And so what we found is that, based on, actually, I have a better weather model here in this presentation. So based on all these different factors that I'm going through: growth, inflation, employment, profits, fiscal policy, liquidity, broad money supply, interest rates, positioning, all these different features at various times can really impact asset markets based on their, excess return dispersion regimes. And what we found in terms of building this model was saying, hey, look, we don't know what's going to cause markets to materially inflect, correct, bottom, top at any given time. We have a general view on what that might be based on that original process, that Goldilocks reflation, inflation, deflation process is. But in terms of like, okay, now is the time to put the trade on. Now is the time to cut risk. Now is the time to get out of the trade altogether. That stuff is a lot more stochastic than your ability to predict, than anyone's ability to predict, if they're being honest. And so we built this system to help us stay abreast in a very quantitative, systematic way on all the things that matter to asset markets, and they all matter in different times, different times to different degrees for the different asset classes. And so this is one of those instances I mentioned that you got to constantly be evolving your process. Another thing we did, going back to January when we pivoted to transitory Goldilocks and got out of this sort of just ultra bearish mindset of got to short every rip, which was working for the most part, really since December of last year, 2021, when we pivoted to being bearish. But, that obviously very much stopped in October of last year. And so in January, when we pivoted to transitory Goldilocks, we actually stopped shorting altogether. And the reason we stopped shorting altogether was because I realized that, one, I'm not good at it. Like, I think very few investors are actually good at shorting. Two, I don't have enough time to risk manage like bimodal tail risk. Shorts can go up on you, just longs can go down on you. And I have to do client meetings. I have to do, constantly be creating content. Like, it's a full-time job to manage a portfolio. And if I'm, doing this and obviously, meeting with clients and whatnot, then I'm losing hours to actually do that and execute that in a good way. So having the humility to say, look, I'm not good at this. I don't have time to be good at this. Let me just chop this off together and build a systematic system that actually does what I think investors should be doing in the markets, which is not thinking you're smart enough to pick this long, pick that short, get perfectly into it on time, get perfectly out of it on time. There's so much stuff that has to go right for you to make money in discretionary trading. And so we built a systematic, kind of long only portfolio construction process at that time to basically say, hey, look, this is probably what you should be doing anyway, and it incorporates the weather model signals in addition to those grid model frameworks.
Yep. And your system, and I'm glad you mentioned the sort of down day, because it's always good to as an investor or in this business, you have to be willing to confront those, or you're gonna never learn anything. But your system or your thought processes, your research, the work you're doing has produced an understanding that a lot of people didn't get. That's been positive for you, at least. It's positive in proving out the value of your work in 42 macro, just understanding the extent to which this economy has been resilient. You were kind of early to that, if I remember right?
I'm not gonna lie to you, Nick. I think I created the view.
Yeah.
Like, I go back and I listen to like what people were saying in August of last year, because that's when we started with the theme.
Yep.
I couldn't find anybody else that sounded like this, right? And so, not to take a victory lap, because I don't think taking a victory lap is helpful for anybody. What I think is it's important to explain in real time, or at least after the fact, to say, hey, look, that was the outcrop of me doing the exact same things every single day. I mean, one of the most boring things I do every day is I analyze all the key high frequency economic data in rate of change terms, delta terms, how is it relative to your trend, every single release. So if the consumer confidence report comes out and there's 20 different sub indices in there, you can I analyze all 20 of them, right? Like, and it's like 90% of the time there's no information, right? It's not no new information that's going to really materially impact asset markets.
Yeah.
But 10% of the time there is. And 10% of the time you need to know this stuff. And so, like, to me, it's like that 10% of the time is the difference between, or sorry, not even that 10% of the time. It's that 90% of the time that was the difference between me saying, hey, the economy is still resilient versus everyone else kind of getting, super wed to these bear porn narratives. And again, it's not to chastise bears or anything or folks who just kind of had that call wrong. We all get stuff wrong, right? Like that's not what we're trying to do here. But it's to say there is value in Bayesian inference because that Bayesian inference process allowed me to say, hey, look, nothing's really changed this whole time. Economy's still resilient. And then there's all these fundamental reasons why they're resilient, we can kind of touch on in a second. Actually, I'll just list them because I think a lot of them are actually, folks, if you are bearish or someone who's, not participated in the right tail risk that this market has experienced this year, I think there is something to learn from that particular instance. And I think, just in the Bayesian inference, in my opinion, is the number one thing you should probably take away. Just constantly having actually a process to understand what's happening in the economy, not just only doing research on the thing you want to have happening in the economy. That's what a lot of folks get wrong. But number two is that there's a lot of information a lot of avenues for further research that investors should sort of take from this particular resilient economy thing, which again, we've been there since August of last year. There's kind of 10 factors that are contributing to that to different degrees. And some of them are going to be persistent. Some of them are, it's going to run out at some point. But number one is the near record cash on household balance sheets. Number two, there's near record cash on corporate balance sheets. Private sector income and wealth have outpaced inflation throughout this business cycle. You have these limited credit cycle vulnerabilities, i.e. we don't have the capital misallocation that you've historically seen ahead of recessions and, moderate to severe recessions. We have limited exposure to the more volatile manufacturing sector as low as it's ever been. With long and variable lags in this particular cycle because of how much debt has been termed out and the spread between, what folks are realizing relative to what they can refinance into. We have this perfect storm for new housing development, largely as a function of that, in terms of, folks not wanting to move and just creating a real, dearth of supply in the existing home sale market. You got Bidenomics, government investment is growing 11.5% year over year. Not many folks are talking about that. You got immigration as well, and then labor hoarding. So all these different things are, to varying degrees, are really contributing to the resiliency of the economy. And most of these things were readily available to observe back in the summer of last year. Not all of them, but many of them were certainly readily available to observe in the summer of last year. So in the context of just this Bayesian inference process of constantly bean counting and delta and rate of change and trend terms, all the economic statistics that come out every month, and we do this for every major economy, it's not just the US, bean counting the data and actually having a deep institutional knowledge of how the business cycle actually works really allowed us to stay on the right side of that. And that's not to say we traded everything perfectly. Nobody trades any of their views perfectly ever. I mean, if you do, congrats, but most people I talk to on the buy side don't do that. So it's not, again, it's not to say we're taking a victory lap or traded it perfectly, but it's to say that there is value in being Bayesian. In my opinion, I think there's more value in being Bayesian than there is being, this super smart researcher who can come up with a theme and give you all every confirmation bias tidbit about the theme and turns on Twitter every day and triples down on the theme and they get a new data point. But the reality is that's not what institutional investors do. Institutional investors are Bayesian. They have robust processes that allow them to not miss things. And that's what I think a lot of folks are missing.
Yeah. When I think about that list of 10, I don't study this stuff like you do, but my macro view was probably consensus, which was like there'd been so much damage in the leading edge of the economy, places like venture and crypto, so many tech job losses, problems in my world, real estate, that you just had to, this had to just come to an end. Like the economy can't grow in the face of that. And I was, very confident of that view. And I thought, honestly, by this time, the Fed would be like cutting rates. But here we are a year later, and they might keep raising. Who knows what's going to happen? They're certainly not going to be cutting anytime soon. The GDP keeps going. Labor market's looking strong. This is a really unusual time. Yeah.
It's super unusual, man, because to me, this labor hoarding thing is a real deal. I do want to share this chart on labor hoarding because to me, it's the one thing that I don't have none of us has any real institutional knowledge on how this is going to play out because we've never really seen it. Right, like if you go to this labor hoarding dynamic, so what I'm showing in this chart here is the total labor force that's at 167 million people. This is corporate gross domestic income. So we have yet to recover the trend on the total side as a labor force, but almost 2 years ago, basically in the a year and a half ago, we recovered the trend in gross domestic income. So what does 1 + 2 mean? Because we got a bunch of cash in the economy for goods and services, but we don't necessarily have a bunch of people to create the goods and services. So there's an imbalance there to start with. When you go to this panel here, the blue line here shows labor demand, which is the total amount of people employed according to the household survey, plus the JOLTS data for the JOLTS total job openings. That number is 171 million. That's higher than this 167 million, which is the same number from the previous panel. And so we have this positive spread between labor demand and labor supply, which is as far back as we can get the data since like 2000. It was by far the highest positive spread we've ever seen. And right, this positive spread, which peaked, I want to say, somewhere around 6 million in early 2022. It's just shy of 4 million now. This positive spread is reasonably correlated with the private sector employment cost index, which makes a lot of sense, right? Like we all know basic economics. If there's more excess demand for a good or service, or in this particular labor services, then the price has got to rise. And so this is why we're seeing this structurally elevated wage pressure here. But one thing that's I think is kind of like really like if you want to have a soft landing talk, it comes down to this bottom panel here, and this is something that Jay Powell explicitly called out at the beginning of the tightening cycle last March, which is if we're do this right, you can take a lot of the excess labor demand out from this function here in this panel here, just purely based on declining job openings. Now, there is no history of that actually working, right? Like we've never actually seen that. One, we don't have JOLTS data back. We only have JOLTS data for 2 recessions. But the reality is like that's clearly not what tends to happen, especially when the Fed tightens policy as much as it has. And so, you have to have a real serious conversation about, hey, if what they've done in terms of getting policy to this level, the policy rate to this level, means if it's not truly as restrictive as we all thought it might be, 18 months ago, and this continues to happen, there is a credible path for a soft landing. And if we soft land, I will be the first person to give Jay Powell a ton of credit because he explicitly called that out as a potentiality at the beginning of the tightening cycle.
That's so interesting. Yeah, I've heard in some of your other recent appearances talking about this other idea, which I don't really know if it's counter to that, but it's a different way of thinking about it, which is like you could never get. It's essentially about the relationship between inflation and GDP growth, and how you need to get. I'm not remembering exactly how you have it articulated, but it was essentially the idea that inflation doesn't come down unless you have a recession.
Oh yeah, I got you.
Yeah.
I got you. Yeah. I know exactly what you're talking about.
Yeah.
Let me show you that. So there's a couple slides I'll show you on as it relates specifically to inflation. And this is why, on our belief, this is why we are in the camp that we will have a recession, because we don't believe that the Fed is going to achieve the inflation outcomes that it wants to achieve. Yep. And so when you go back and you study recessions, and so I think this table here shows kind of helps investors understand what a recession is, what it looks like in employment terms, what it looks like with respect to the market, what it looks like with respect to inflation, what it looks like in respect to the action in Fed policy, and also in terms of like how what the vulnerabilities were heading in the recession, as well as the type of recession. So if you want to know anything there is to know about recessions from a financial market perspective, participants' point of view, I think it's well represented in this table. I'll draw your eyes to this particular column where we show the basis point delta in core PCE and the year-over-year rate of change of core PCE in the year leading up to recession. And what we find is, statistic goes back, I want to say, to late 1959 or whatever. So we only have recessions since the 1969, 70 recession. But what we find is that on a median basis, core PCE tends to be right around flat to up heading into a recession, the year leading up to recession. There's only one negative value in this entire time series, in this entire particular, it's an entire sample. And so what it tells me is that inflation is inherently a lagging indicator. And we know that, right? Like, inflation, in fact, is the most lagging indicator of the business cycle. And you can see this just represented visually with our Hope Plus I framework. What I'm showing in this chart is the median trailing 10-year delta adjusted Z-score of a basket of indicators for each of these particular cycles. And it's orchestrated in months before and after recession starts, with 0 being the beginning of the recession. And this is data that goes all the way back to 1948 for each of these baskets of each of these cycles. So there's probably like 8 to 10 indicators in the housing thing, 8 to 10 or 12 in those, so on and so forth. And some of them have data going all the way back to the 1940s. And so what we're trying to identify is, okay, when does this particular cycle break down in and around recession? And obviously, when does it recover after the recession starts? And what we find is that housing tends to break down right around 18 months ahead of a recession. Orders tends to break down around 8 to 10 months ahead of a recession. Production and profits tends to break down, that these baskets of indicators on a median basis tends to break down around 4 to 6 months ahead of recession. Employment tends to break down right on time when the recession starts, which makes sense. The NBER is obviously anchoring on total employment as a real big key indicator for their business cycle dating, process. And then lastly, inflation. Inflation tends to break down 6 to 8 months after a recession starts. And so when I performed this analysis, like a light bulb went off. It was like, immaculate disinflation is going to end at some point before it's going to end in an awkward moment. Like right now, because we have experienced a considerable amount of immaculate disinflation, in the U.S. economy. We've seen core PCE on a 3-month annualized basis go from, 4 to, it was tracking in the high 4s, low 5s, and it's now 3.3% 3-month annualized. Super core PCE, which is core services ex housing PCE inflation, was tracking in like kind of the mid 4s. Now it's down at 3.2. My fear, based on that analysis, is that it's going to get stuck at around 3. If it gets stuck around 3, we're ultimately going to have to go into recession to get it back to 2%. I don't think it's going to get stuck around 3 in the very near term, but I think, within 3 to 6 months, it'll be pretty obvious to market participants in our view that we're not going back to 2. And that to me is a really bearish outcome for the market, because so much of what has driven the market and the right tail risk that we've accumulated throughout 2023 is this sort of immaculate disinflation that has contributed to, the transitory Goldilocks, vibe that we've gotten in asset markets. Like, to me, transitory Goldilocks, when we made that call back in January, it was the realization that, hey, we thought the economy was going to be resilient the whole time. That's not new to us. But what changed to us in January relative to where we were in Q4 was the realization that we are experiencing immaculate disinflation. Like, at first I was like, this is unlikely to happen, so like, let's just stay bearish. Even if the economy is resilient, they're just going to have to keep hiking, keep doing QT. And then we're going to stay in this kind of same market regime that we were in for 2022. What allowed us to get off that was the Bayesian inference process that allowed us to say, hey, look, we are experiencing a lot of immaculate disinflation. I have no idea when it's going to run out, but we're going to trust our quantitative signaling tools to give us an edge on, okay, when it's time to kind of get off this trade. And right now it's not.
Yeah. And at a high level, like, essentially the problem for the Fed is that they've anchored themselves now for, 20 years on 2%. And so if inflation stays at 3, they've got a credibility issue, which, like, maybe there's a case to let inflation run at 3 as long as the economy is performing decent, as long as there's some kind of real growth. But they've backed themselves into this sort of intellectual corner. And now what are they going to do? That's interesting.
Completely agree, man. I don't think they have a choice. I really don't think they have a choice. They're going to have to pivot. And so, again, this is based on our view. I get paid to have views, right? So we built this dynamic factor model called our secular inflation model. This model takes, the delta adjusted Z-score of all the various indicators that we found to be correlated or co-integrated with the unit root of inflation. And what we find is that when we perform this analysis based on, the latest value for all these particular features, relative to the 2010 to 2019 trend of core PC inflation of 1.6%. And what that effectively means is that when you kind of look at this, kind of the stationary time series that is core PC inflation, this line drawing through it is 1.6%, right? That's what we're trying to get to. That's what we're trying to forecast in this particular analysis. What this analysis says is that in this particular decade, it should be somewhere between 2.5 and 3%, right? Like, what if it comes in on the high end of that range? And here's a reason why it could come in on the high end of the range. Crude oil's at, $70 or $80 now, or whatever it might be, $80 on WTI. I heard people say, a year ago, people were saying WTI is going to 300, right? What if it goes to 100 or 150? So like, I think you could very easily trend somewhere on the high end of this estimate range in terms of core PC inflation throughout this decade, which is an issue because the Fed has a 2% inflation target. And a 2% inflation target means you're going to be constantly leaning against the Treasury, who needs to, issue, trillions of dollars of debt every year with high interest rates and no balance sheet expansion. I have a view that, these guys are all in cahoots. They're all working together, and they're all, they want positive outcomes for the economy and financial markets. And to me, I think the least bad solution from the perspective of the Fed, or the Treasury needing to get capitalized, from the perspective of, not trying to see too much unemployment to get us back to 2%. I think the least bad solution is pivoting to 3% on in terms of their inflation target. They're not going to do that now. They're going to push back against that very hard. Jackson Hole's on the 24th through the 26th of this month. They're going to basically put out a bunch of papers telling you why it's not a good idea to pivot to 3%. But when that unemployment rate's at 5.5% instead of 3.5%, and it looks like it might be going to 6.5%, that's when those papers will start to come out, and that's when they'll pivot. But I don't think they're going to pivot anytime soon. But I think it's coming.
There have to be a lot of pain for them to do that. That's interesting. Yeah, I know.
Yeah.
I mean, we're coming to the end of our time, and I want to be respectful of your schedule here. But there's another risk factor, and maybe we should schedule another interview to talk about this, because I feel like there's two giant risk factors in this whole equation. One you mentioned, which is energy. Energy could go up very quickly and present a real problem because it's a huge percentage of the CPI reading. Totally. And then secondly, actually my world, which is real estate, and in particular like residential and multifamily, because what this weird world, this transitory Goldilocks world, as you call it, has produced is an environment that is devastating for supply, for new supply in this country. It's positive for home building in a sense, because like home builders are capturing more and more market share than they used to, but the net new supply is just going to get materially impacted. And so shelter, which represents like 40% of that CPI number, shelter is likely to be a problem for the Fed as well. So if energy and shelter come in, let's say 6 months from now, hot, then the Fed is going to be backed into this corner. And I feel like we'll be in a different regime, to use your framework.
Yeah, we will be in a different regime from a market risk perspective. To me, inflation is the biggest market risk, right? We've had a lot of stuff happen from a newsy standpoint in the last couple of weeks. Get the BOJ yield curve control tweak. We had the positive revision to the Treasury's borrowing estimates for Q3, and then obviously the Q4 numbers are chunky as well. And then we got the Fitch downgrade. But to me, the number one thing that really impacted asset markets in the last week was the hot ADP print on last Wednesday. And the reason in my opinion, it really impacted asset markets is because what's driving the right tail risk in capital markets has been transitory Goldilocks. But if we go back to a regime where growth is too hot or inflation is too hot or both, i.e. we just stay in this high nominal GDP environment, then we're talking about just another lurching forward of policy tightening expectations. Right now, there's nothing priced in for more tightening. Right, the September meeting's at like 15, 16% in terms of implied probability, and you got zip, zero after that. What if we have to put in another 100, 150 basis points of rate hikes? What if the Fed has to do, they're planning to stop QT sometime in the middle of next year. What if it's like, no, we're just going to have QT running indefinitely as far as the eye can see, because we're never going to get back to our policy objectives otherwise, right? This is a Federal Reserve that doesn't see us hitting their 2% inflation target until 2025. But if there's a bunch of information that comes between now and let's say year end or next 3 to 6 months that says we either have to push 2025 out or you need to do more tightening to get us to 2025, that to me is going to be a really negative, kind of a negative outcome for the market, and will change the regime. We're currently pricing in reflation right now, which is it's risk on, but risk off for defensive type securities like bonds. You could easily go back into pricing in inflation, which is risk off for both, which is what we saw last year. Yeah.
And on top of all that, we got this crazy election. I mean, this is going to be wild. You have this really challenging environment for the Fed plus an election. Yeah.
I've never been more excited and entertained when I wake up to do my job. I mean, I love my job to begin with. Like, it's just macroeconomics is so fascinating. Like, the best part about macro is that like there's no like consensus on what is good macro process. There's general consensus on what is bad macro process, and it's all the stuff you'll read about in Danny Kahneman's work and things of that nature. But what is good macro process is in the eye of the beholder, right? So it's been such a wonderful time to kind of iterate and evolve our tools and processes and kind of stick to some of the basics on some other stuff. It's been great, man. I've been really enjoying this.
Yeah, I can tell. And I really like sort of your top three, and in particular the Bayesian one, because what I've experienced in my own life is that if you get caught up in a framework, you could miss a lot, because the world doesn't fit into these neat little frameworks. And so it helps to have that sort of probabilistic thinking, which is like, well, you might believe that it's a fourth turning and the world is ending and you should buy gold, but you might want to consider the alternative, which is like, okay, AI is here and we're about to have some massive deflationary moment, and bam, like things could really be different than what your fixed framework would suggest it would be.
100%. And if I can leave investors with one final kind of like process, tidbit, because I like to think that I've been coached by some of the world's best investors, many of the world's best investors, in terms of telling me I'm an idiot for thinking XYZ in a meeting and having to go to my desk like, all right, stop thinking XYZ, build something that says Y, right? Like that's a lot of what people see from 42 Macro. It's just like, damn near 15 years of getting laughed out of the room, by some of these top buy-siders. I'm not laughed out of the room, obviously, but, having these really difficult, collaborative discussions. And so just one thing I would say, just in terms of being Bayesian in the context of having a longer term structural framework, is to understand that, hey, look, even if you have a longer term structural framework that you've done a lot of research on and you believe in it, your research process should not be an outcrop of that framework. You should not be going to find more information to support your view. I say it all the time on Twitter. I call it, we have a research and risk management process at 42 Macro. A lot of what I see on Twitter is a confirmation bias process. People wake up looking to find incremental evidence of their thesis. And to me, I think that's just a very dangerous thing to do in the context of investing. What you should do is, hey, I have my longer term view, fourth turning or whatever it might be. Raoul's got exponential age. Have this longer term fundamental framework, but constantly be looking at the same sets of data and indicators that may or may not have anything to do with your framework to give you more or less confidence to implement that framework in position sizing terms and actually in actual factor exposure terms as well. Because not every piece of your longer term view needs to be priced in at every moment, right? Sometimes it's going to work, sometimes it's not going to work. And you will be able to understand that better, those on and off switches better if you have a more Bayesian process.
Yeah. Well, I think that's great advice. And I think it's a great place to end this. I'll make sure everybody has links to 42 Macro and to your social handles and all that. But Darius, thank you very much for your time. This was a super fun conversation and appreciate you being here.
Likewise, Nick. I'm really rooting for you, really proud of you, man. And thank you for having me, man. We'll definitely catch up.
Yeah.
And you and I are going to be having a deep dive discussion on commercial real estate next month in our pro discussion. So
I'm looking forward to that. Yep. I'll make sure everyone knows about that too. All right. Thanks, man.
Thank you so much, Nick.
Thank you for listening to the Nick Haleris Show. We hope you enjoyed the episode and would appreciate your help with spreading the word by sharing with your network on social. And until next time, remember, it's not about pursuing success to unlock fulfillment. It's about learning how to find fulfillment in the midst of success.